yesterday I did a video about the earning announcements and the 10-day period around those announcements and how the price and implied volatility were correlating within those periods. And so I wanted to go into a little more depth today now that I've had a chance to sit down and analyze it and talk about it a bit more. I really wish that I had seen this correlation much sooner because according to my analysis, Monday and Tuesday are kind of the last days for the earning call announcement price action. If you see something that makes sense or if I've got something that's wrong, like please comment, let me know. I'm trying to put together the best forecast that I can, and with this new information, it's just a lot to have to process. I think though overall my forecasting doesn't change one bit. If you've watched my videos, you know that I have some upper price targets that I'm expecting to be met. On my daily chart, I have a symmetrical triangle. On the 4-hour chart, there's a double bottom. On the 15-minute chart, it's possible that there's a broadening top that has an upper price target as well. And those series of price targets and price confirmation levels would lead the price up into the $80 to $90 region. And that's not accounting for momentum or for any potential upward pressure from the options chain and hedging. So my analysis does support a really big run next week. And if that happens, that'd be great. On the flip side, though, the analysis also has a forecast that's a little more bearish. If next week doesn't feature a spectacular run, and I mean a spectacular run, then I anticipate another floor test down in the mid 30s. And there are some chart patterns that point to that too. There's a head and shoulder top forming on the 15-minute chart. And what I'm going to show you right now is a potential rising wedge, which also would have a lower price target. Now, I want to get into this, and I'm going to show some different correlating earning price action events. And I'm going to start by showing you this guy right here. This is an earnings analytic tool by TD Ameritrade in their Thinkorswim application. And I was flipping through these looking for correlations, and I found in the second fiscal quarter of 2020 earnings announcement period and the first fiscal quarter of 2021, that period had a correlating percentage change in price in terms of trends and also an implied volatility. And there is some divergence in the implied volatility, but they quickly line back up again. You'll see that the price goes way up, all right, by 5 days after the earnings call. For these two periods, the price has increased 30% from initial, and that really caught my attention. So I went ahead and charted both of those periods, and I'm just gonna zoom in a little bit here. This is the first one, and I grayed out, or I've taken the color away from my price candles, and this represents a more traditional sense of charting in that the white candles are green and the black candles are red. What you're going to see is these lighter gray lines showing a V, and this is a bottom. This is a sort of V-type bottom, and the overall move itself is a 1, 2, 3 trend change. I'm going to go ahead and pull that up really quick. Let's see here, make sure nothing too telling is on my browser. Okay, so whatcha? Here we are on the patternsite.com. This is Bulkowski's website. This is the reference I use. There is so much information here. If you think there's a lot here, you should try his books too. Okay, so the 1, 2, 3 trend change. And he goes in and he describes this stuff. And just look at this example, for instance, in Abercrombie and Fitch. All right? You have this initial downtrend, a bounce, a little corrective phase, and then this gap, this breakaway gap, and then this new trend starts. That looks so much like this, where you have this initial downtrend, a bounce, a little corrective phase, and then a huge gap up, and then there's a trend change. So I thought that this was a pretty clean analysis of how this earnings period went. And I did notice the RSI was in the oversold region, and that implied volatility was really high. 2.6, so 266% implied volatility there at the bottom. And you'll see that during this period, the implied volatility peaked in the middle and then didn't come back up, but nonetheless, this price jumped. So the implied volatility might be less consequential than I was thinking yesterday, but I do think that it's an important aspect of how this plays out. If if there was a meaningful rise in implied volatility during this time, it probably would have signaled a greater run. But because implied volatility was diminishing, the options chain would become less and less valuable on the bullish side. So that's kind of how I think this first one played out. Now I'm just gonna scooch over and I'm gonna go to the next one. I'm gonna skip that, and this is the correlating time period. I'm gonna pull this back up. So this one's green, and that first area was highlighted in gray, and this was highlighted in green because that's the colors that Thinkorswim is using on the earnings tool over here. And I don't have the ability to change what these colors are, but I figured I could at least make a match. And I understand they're hard to see, and I apologize for that. This one, though, you can see the green pretty well. And you'll notice right off the bat that the shape of the chart pattern is the same. It's a V-type bottom, right? In this case, this was actually a rounding bottom. Not a cup and handle, not a V-type bottom, not a 1, 2, 3 trend change, but a rounding bottom. And I guess you'd call it a trend change. You could probably look at it like that if you really wanted to. I wouldn't force it though. And what's different about this particular bottom from the prior is the relationship with VWAP. I have this in blue. Now this VWAP is based on the monthly price, so it's not going to be indicative of daily or weekly moves. It's taking a long period of time. And the bottom here comes down below and then launches up and finds that VWAP as support moving upward. Going back to the first one, you'll see that the VWAP, and this is the monthly VWAP, drops and comes right down to where that triangle is, that bottom. So as I was saying, it's not about daily or weekly. So to have the monthly VWAP drop into the bottoming candle, this is different. This was a hard sell-off, a hard drop. And then the price recovers, it plays out like a bottom should, but it doesn't have the momentum it would have gained had the VWAP remained above the bottom. That is to say, if the bottom wasn't so high in volume. And that's why I like to talk about how low volume is currently, because falling below a volume-weighted indicator on low volume signals correction. And that's exactly what you saw here. And again, the price came up. It came just below that volume-weighted average price, and momentum and implied volatility increased. And that's probably the biggest thing here, is during this earnings period, you're going to see the implied volatility make a meaningful increase from, I mean, as low, it was at 134%, and it rose to a high of around 190%. So the meaningful rise in implied volatility on this earnings call period, I think, performed far more bullishly than the prior because of that implied volatility and what that means for options contracts. If you recall, I believe the entire options chain went into the money during this, or half of it did. I can't quite remember. I remember for a while there were a lot of $145 calls that were just bonkers. But the $75 call was also at the top of the chain. I might need to go back and look at that again. But I like that. Below VWAP and then all the way up the options chain. Meaningful increase in implied volatility. Okay, so now let's talk about the next two correlating periods. And this includes the current, the third quarter of 2021 earning period. This one on the right, it's really jagged. It's all over the place. It's very volatile. And let's see here. I decided that this was the correlating earnings period. The implied volatility you'll see is much different between the two, and that has to do with just historical context, what happened prior to this earnings period. So in this instance, implied volatility is starting much lower, okay? And so that would suggest that the options chain is going to have less, is going to be less affected by a move. Now, the percentage change in stock price, I see it correlates fairly nicely, but in the matching earnings period from the current, which, okay, this was the fourth quarter of 2020, the price surged, and we didn't see that same surge. It could just be that the timing is a little different, a couple days off. That's feasible. And it even looks that way when I was doing the charting. So now I'm going to go back and I'm going to show you what that charting looks like. This is that first one. And what you'll see might look familiar. This is a rising wedge. You'll observe 1, 2, 3, 4 waves, and actually, I was looking at it this way too. This could be leading triangles. If you're an Elliott wave theory person, let me know. I know very little about Elliott wave theory, but what I do see is 1, 2, 3, 4, and then a fifth wave going up. And I know that this can be a bullish formation, but in this instance, it was not. So the price, found support on VWAP and went up and almost broke out. It technically did break out of this rising wedge, only for a pullback and falls back down. Okay, and this level here, this $8, $9 region, at this time was essentially the floor. So we had a rising wedge and a floor. And you're going to notice, I want to point out, the big fifth wave, the big jump up, occurs 2 days prior to the end of that earnings period. And you'll see that reflected here in this big peak that's 2 to 3 days after the earnings period instead of 4 to 5. And when I zoom to the other side, the current period, you're going to see that the earnings period would end on the top of this fifth wave. So when I scooch over here, is it going to give me my, there we go. I'm just going to chase this. Maybe I edit this out. Maybe I don't. Okay, we have a similar wedge forming here, and I'm just going to zoom out a little bit. Okay, there it is. And what's different this time is that the price is below VWAP, and we'll be piercing through VWAP in order to accomplish that fifth wave. That would put a high above these two, and that would bust the head and shoulders top on my 15-minute chart, and it would also reconfirm the double bottom on my 4-hour chart. And if those two things happen and the double bottom on my 4-hour chart goes to its price target, the symmetrical triangle price target is going to be met, and then the falling wedge, and then this ugly double bottom price target up in the 80s, and then it'd be momentum upward. So this is what I want to say is, if this pattern turns out to play like a rising wedge that breaks to the upside, it's a green light. It's a big green light, huge green light. But if this wave does not shape out like historically has happened in the earnings period, then a fall down to this 34.16 region is kind of inevitable. Let me give you an idea. So I did all of this studying and I observed all of this, and then I went and checked my other price targets. So on the bottom side, if there is not an incredible move on volume tomorrow, on Monday, perhaps Tuesday, but probably Monday, then the risk increases drastically of another floor test. So if this wedge breaks down, I have a 34.16 price target for it. On my, not the 1 minute, but on my daily chart drawings, you'll see the symmetrical triangle targets at 29.08. So if the rising wedge breaks down, the symmetrical triangle goes into breakdown mode, and that's the target, is 29. If we look on my 15-minute chart, you're going to see in yellow that I have a broadening top, and there's a 34.80 and a 32.78 target there. I'm going to go to my weekly too really quickly and just show you where that floor is. Oh, it's not even labeled. That's interesting. I thought I had that floor labeled, but it's about $33. So tomorrow is going to signal whether or not an incredible momentum-filled run starts, or we see some really boring, what we like to call sideways action. All right? Because it's very, very possible that we're just going to see a repeat of what we saw earlier this year with this orange rising wedge. All right? This is a likely scenario to see something nearly picture perfect to repeat here. And I say that just because the implied volatility is low, and unless we see a big spike in volume, it's just not going to work out for the bulls. So that's what I've got. It took me a long time to do this analysis. Now, really quick, I want to show you some more stuff on Bulkowski's website. He does talk a little bit about leading diagonal patterns, and you'll see this 1, 2, 3, 4, 5. And I've been talking about those rising wedges in that context. And this would be a bullish pattern in Elliott theory. Bulkowski right away says, I have no idea what this means, but I couldn't have said it better myself. Because, I don't know, there seems to be a pretty common divide between Elliott theory and like chart patterns. I don't know why those two schools of thought aren't married together, but it seems like you either know one or the other. And I'm a chart pattern guy, not an Elliott theory guy. So if you know things about Elliott theory, I'd be really interested in your input. You could look into those earning periods in the way that I've highlighted them, and then you can inform me if I'm missing something.